Hi, I'm Mike Wolf here from Mike Wolf Mastery, where I teach you how to make more money through real estate investing. Well, today I'm going to teach you not just how to make more money, but how to keep more of your money. Because a friend of mine sent me a message yesterday saying that one of the big Canadian banks is charging them this huge interest rate differential, or IRD. Now, for those of you who don't know what an interest rate differential is, basically the bank, when you take out a term in Canada, usually it ranges from 1 to 5 years. It can be longer. It doesn't matter. The bottom line is that when you're agreeing to borrow the money for certain amounts of time, when you pay it back early, the bank doesn't like that unless you happen to have a really low interest rate, in which case they can lend it out for more money. So what they do to make up for this is they basically charge you the difference in interest that they would have made had you kept that mortgage going. Usually there's two potential ways they charge you when you get out of a mortgage early. One is the interest rate differential, which I just spoke about, or they'll have a payout penalty, which is usually 3 months worth of payments. And so they'll do whichever is higher. Now, what's happening with my friend is that they're not just charging him an interest rate differential based on the rate that he's got. He's got a great rate, which is 2.9, I think he said 2.9%. It was under 3%. So, but instead they're charging him based on what the posted rate was at the time that he took out the mortgage, which was around 5.25%. So basically they're charging him for the next 2 years as if he had borrowed the money at 5.25%, and they're anyway, it's a huge sum of money. So I'm going to teach you some ways to get around this interest rate differential and totally eliminate it. And then if that doesn't work, I'm going to give you some options how you can reduce it. So the first way is to get around it is to do what's called porting the mortgage. That means you're going to take that mortgage, you're going to move it to another property. It might be a property that you already own, or it could be a property that you want to purchase. Now, I personally am not a really big fan of buying real estate in Canada at the moment. I don't think that's a very great idea. So if you don't already own a piece of property, I definitely wouldn't go buy another property just to save on the interest rate differential. It's not worth it unless you found a really smoking deal. The number two option is your new buyer. If they take over your existing mortgage, now they're normally going to have to qualify. This is called an assumption of mortgage. If they assume your existing mortgage, you will avoid the payout penalty in most cases. So because your interest rate is really low, it may be advantageous for them to take that mortgage over as opposed to getting a new one. If they can get an even lower rate through their bank, the other thing you could do is potentially offer them a chunk of cash, obviously less than what you pay the bank, give them a bunch of cash or some cash to make it more attractive for them to take over your mortgage and once again help you save on your interest rate differential. So those are a couple of the ways that you can totally eliminate this IRD. Unfortunately, that doesn't always work, and so some of your options to minimize it are: one, most of the banks have a prepayment option where you can pay up to 20% per year. So what you want to do is when it gets to the lawyer's office, when the deal's ready to close, you want the lawyer to send 2 checks. The first check is going to be for that 20%, and sometimes you can do the original principal balance, not just the balance today, but the original balance. So you can have them pay 20% of that original balance, and that amount won't be subject to the IRD. Then he'll send a second check for the rest of the money owing, and you'll still have, unfortunately, a big chunk to pay, but it'll be a lot less than it would have been. So that's nice. The other option is you can make, typically the banks allow you to make double payments every month. So on top of that, you could also make a double payment for as many months as you can until the deal closes. So once again, reducing the principal balance of your mortgage is going to really help you save some money at closing. Now the other thing is if you can stretch possession so it goes into the next year, goes past January, quite often you can make 2 20% payments. So you could do one in December and then one in January. And if you don't have the money to do it until after it closes, there's people like me that will gladly lend you the money. Obviously, there would be some interest and whatnot, but you could potentially pay off, make 2 20% payments on your mortgage. And those are a couple of the ways that you can really reduce that interest rate differential and take a little bit of the bite out of it. So I hope that helps. If you found this of value, please subscribe to my YouTube channel. I'm going to, as always, keep providing great content for you and help you to make more money and save more money in real estate. So I look forward to seeing you soon. I'm Mike Wolf. Thanks again for tuning in.